So we got a question, and this is a generally a pretty common question you'll get is how much cash you should hold, how much of a percentage of your portfolio, and really how often should you rebalance it. They specifically ask cash in a climate of reduced purchasing power and increased money supply. How much cash is a percentage of total portfolio should one keep? Should you rebalance once a year? A person's age is a consideration. So we can really break this down into a few factors. So what is the percentage of cash you want to have? What's the rebalancing frequency, and as well as the age. And I'll add as well into that what other considerations should you consider as well. All these factors interact with one another and may change depending on market conditions, but you can generally get a good idea once you look through really your own considerations. So first, the few considerations I want to go through. Age is the biggest one, but it's not as much about age, about where you are in your investor life cycle. This is an image from Investor Capital, but you'll see many, many articles on this online. So when you're initially investing in your 20s or 30s, you have a long time horizon. You're starting to accumulate wealth, but you also have some big expenses like houses coming on that you'll need to purchase soon. And then in your later years, you might have some kids, but you're also have a higher income in that point, so you can really reinvest in that point. And then in retirement, you're starting to draw down on the wealth which you accumulated during those prior periods. So it really depends more where you are in your life cycle. Are you planning to retire early, late? Do you have kids? No. It's those types of considerations where you actually are in your actual life and not just strictly your age. So, but how much cash you want to have really comes down to foreseeable or planned expenses and unforeseeable and unplanned expenses, which age can give you an idea of, or your investment life cycle where you are in it. So for foreseeable expenses, they include big expenses. I'm not just talking routine daily expenses, which would really be coming from your income, then out of your income. So these expenses are like buying a house, kids' university tuition, effectively really any sizable planned expense. It could be a large vacation, something like that as well. If you have larger expenses, the more cash you'll need to hold, obviously. Further, the closer that expense is to you. So if you are planning on buying a house today or within the next month, obviously you want a higher cash position than if you were planning to buy a house 10 years from now. Because if you hold a cash for a longer period of time, you're effectively giving up returns for that extra safety in the short term, which when you're looking in the long term, you don't want to inherently do that. So in other words, if you're buying a house 10 years from now, don't be holding cash for it. You should really be invested more into risky assets, and it should be effectively 100% when you're looking at that allocation in respect to your house. But the other type of expense is really unforeseeable, unplanned expenses. There are things like medical expenses, which you don't expect, non-routine maintenance of household repairs. So if you break a window, if Brennan's throwing rocks at your house again, that's when you will have to obviously have an increased expenses, stuff like natural disasters as well, auto repairs, that sort of stuff. Things which you can't either expect when they happen, and even if they do, you may not know the amount beforehand. So you really just have to plan for those things, but you can't completely eliminate it. Sometimes you have insurance for these, but even that, if you do, insurance might not pay out right away. So you always want to have at least a bit of cash on hand to cover your short-term expenses, because if it is something like a tornado or a catastrophe insurance scenario, it might be months or even a year before you get that money, or even longer in some cases, depending on exactly how it is. You'll need to budget for that and really just check on how your insurance and insurance policy and so on is what you should be looking at there. So therefore, but past that, you really want to you want to set cash aside for about 6 months to a year of normal routine expenses. You need to budget for this, and you can check against your actual historical expenses to get a rough idea. And then as well, you want to add in a bit of a buffer to that as well, because whether prices are changing and so on. So 6 to 12 months is a good baseline of routine expenses, which you can use as a baseline. So then on top of that, you'd add your foreseeable planned expenses with those unplanned expenses plus the routine expenses. And therefore, you'll get a ballpark figure when you divide that by your total portfolio. It would likely be in the range of anything between 2 and 20% of your total financial wealth. It really depends on the person a lot. So don't really pin yourself to a percentage of a target of your total portfolio value, as this will change over time with your expenses, your portfolio size, and so on. So don't think of it as a straight percent. It's so for some people it might be a bit easier to think of it in absolute dollar terms or in terms of months of expenses. So you want to hold between 6 and 12 months of expenses, or you want to hold $20,000 or so on, instead of I want 5% of my portfolio, because that has a lot more factors in it, because that includes your investment as well. So it might be simpler when you're looking at your short-term cash needs as a dollar amount instead of percentage. And I will caution here as well, holding cash is actually a risk as well. Holding too much cash is a risk because on average, it will get a lower return than effectively every other investment, particularly if you look at riskier investments, stocks, or so on. So if you hold too much cash, it may put your retirement plans at risk because you aren't able to accumulate as much wealth over time. So someone in like me in my 20s, if I'm holding cash now, is realizing about 4% over the long term, even less than that for long-term bonds, compared to an average 10, let's say 8, 9, 10% return on the stock market, when that's compounding for the next 30, 40 years, that is just a substantially massive difference in growth. And you really don't want to over-index yourself into cash just because you see it as, oh, it's less risky. It can actually produce more risk in the long term because you're foregoing that growth in your portfolio. So another type of cash you may end up having is really transitory cash, is what I'm calling it. It's cash you have from selling off another investment for whatever reason that might be. It might be it hit your target investment. It might be it's underperforming. Actually, whatever that reason happens to be, you sold the investment, you have cash on hand. You generally want to minimize this as it creates that cash drag. It has a lower return inherently. So you want to generally reinvest that as quick as you can. But at the same time, you can use this as an opportunity to reevaluate your cash holdings. Does it still meet your current expenses and so on, especially if it's a larger amount? But as well, you don't want to rebalance constantly. You do not need to, especially when it comes to cash, as it should slowly be increasing. On the chart I have on the screen, you can see the percentage change. But every year, that has a 4.5% increase. And I just put some arbitrary, realistic numbers into the risky investment returns there. And you can see it goes up and down. But every year, the cash is increasing. So if your expenses and your planned expenses stayed the same, that's fine. The percentage doesn't really matter here. It's really just the actual dollars in isolation that you really need to pay attention to whenever you're looking at that transitory money, if you need to top it up. And as well, you don't really ever need to add more cash into this once you have that initial emergency fund in there, as it should just slowly be increasing with interest rates. So unless you have increased expenses for something like that, where your plan actually changes, that's the only time you really need to actually top it up. So if anything, you are lowering your cash by reinvesting it into other assets, less likely so than raising it unless you get an unplanned or expected expense. And as well, perhaps one of the things which people overlook a lot of the time when they're holding cash, especially a retail investment, is when we say hold cash, we don't mean you're just putting a cash in a checking account that has no interest or anything. You should be holding in cash equivalents or cash-like investments. So these things can be like ETFs, treasury bills, short-term treasury bills specifically. You're looking at normally a 3 to 3 month one. It will be a baseline for that. As if you're just holding in a checking account or even a standard savings account these days, you're generating effectively nothing. And as long as if you're not going to need that cash literally the day of, you can invest into some different assets. We have an entire report on it. It is about 6 months old now, but we will be looking to update it as well. And these things, it will go over things like ETFs as well, the treasury bills, then investment savings account, which is different than a normal savings account and allows for a bit higher return. But then there's risk and reward trade-offs with all these types of investments. And you should really look into what might fit in your scenario. And really just to drive the point home, if you're holding in any of these, you're getting around 4.5% to 5% interest every year at the time, because it's always based on the short end of the curve. So if you hear interest rates are going up or down, these rates will change along quite closely with it. It's very closely tied to those rates. Versus if you're holding in a checking account, I personally get 0, and I think the savings accounts right now are about 1% to 2%. So you're getting, if even a half of the percentage of return holding in one of these versus these more new types of investments when it comes to like cash ETFs or investment savings accounts. So really look into these if you're looking to have an emergency fund or any type of cash holdings in your account. Look into it, because at least then you can get something out of your cash and just instead of effectively 0%. But yeah, I don't know if you guys have any
Yeah.
comments there?
Like one thing that I would say, it's a great example with like, upcoming expenses in someone's life. For example, like look at my own situation. I opened up an FHSA. I'm looking to potentially purchase a home within, the next 2 years or year here. Well, that FHSA is sitting in one of those cash ETFs essentially because I'm trying to keep it liquid to, potentially move on the purchase of a home. So I think that is a great point that you made, Brett. Um, and even looking, how much cash should you hold? Well, you know, short term could be potentially how much expenses that you have, or maybe some, have an emergency fund um, for a certain percent or a certain amount of expenses that may arise. For example, like your car breaking down or whatever. I do know, like I do listen to Dave Ramsey sometimes, and again, I agree with some of the things he says, and some of the things I don't agree with what he says. But generally, I think he preaches like about a $10,000 emergency fund
Hmm.
as well. But yeah, no, I think that you did a good job there, Brett.
Yeah, when you look at standard portfolio theory, when they say, oh, 6 months of expenses or whatever, most people, I mean, sure, in a perfect world, most people aren't going to be able to do that. It's
Yeah,
just unrealistic. But having some cash squirreled away for an emergency is not a bad idea. What that number is going to be is really going to depend on what the family situation looks like, and also the capacity, more so even the capacity. But
yeah,
one of the things that I always say to people is that we talk to a lot of investors. Everybody is so widely different, right? I mean, we can talk to two investors that are the same age, have the same size stock portfolio, and two completely different investor profiles.
yeah,
So there are different reasons to hold cash. I mean, sometimes it just comes down to I made, a good return. I liquidated, I took some partial profits on a company that I did really well on. What do you do with the rest of that cash? Well, if you're an individual stock investor, it might make sense to be patient with how you deploy it. But
yeah,
that's good. I mean, at least now, in the past as well, in terms of what to do with the cash you have, we've always just said, well, you may as well just put it in the bank because, money market funds, GICs are not paying anything. At least now you can actually get a
Hmm.
return, which is,
yeah.
so there's something to talk about. And that's the reason why we put together the cash report that Brett had shown.